Right. That sound you just heard, that's the sound of your trading bot making 100 grand in a backtest.
Right.
And then blowing the whole account on the first day of live trading.
The classic tale. The Lambo dream turning into a push bike reality. Seen it a million times. Someone comes to me buzzing, "Mate, my system's flawless."
Yeah.
And they show me this equity curve that looks smoother than a baby's, well, you know.
And my first question is always, all right, that's cute. Show me the drawdown. Because we're not kids looking at the final score of a football match.
No.
We're here to talk proper, grown-up CMT Level 2 stuff, which performance metrics actually matter when you're testing a system. This ain't for the tourists, people.
Exactly. The first thing you learn is that net profit is a vanity metric.
Totally.
It's like judging a boxer on how many fights he's won without asking if he got knocked out cold in every single loss. So let's start with the basics. The first filter. Profit factor.
Simple but brutal. It's just your gross profit divided by your gross loss.
Yep.
If you made £1 million, but you had to lose 950,000 to get there, your profit factor is trash. It's sitting just above 1. It tells you that you're basically one bad trade away from disaster.
It's the business sense metric.
Right.
Yeah. Are you running a tight ship, or is money just flying out the back door as fast as it's coming in the front? For my Forex systems, if I see a profit factor below, say, 1.5 in a back test, I'm already getting nervous. I want to see at least 1.75 or 2 to feel comfortable.
In crypto, it's even wild. The profit factors can look insane because of one lucky 100x coin. But when you average it out across all the rug pulls and the scams, it's a bloodbath. A good profit factor tells me the system has an edge, not just one lucky lottery ticket.
Okay, so profit factor is our first checkpoint. If the system passes, we move on to the main event, the one that separates the men from the boys. Maximum drawdown.
The king of pain. This is the metric that will personally attack you in the dead of night.
Yeah.
It's the biggest drop in percentage terms your account takes from its highest point.
Illustrative.
If you turn 10K into 20K and then it drops to 12K, that's a 40% drawdown, mate, from the peak.
And that's the moment of truth, isn't it? I mean, the backtest might say the system recovered and went on to make $1 million.
Sure.
But could you, the human being with a mortgage and a heart that beats, actually sit through a 40% loss and not pull the plug?
No chance. You'd be a wreck. You'd be up all night staring at the charts, convinced the bot's gone rogue.
Right.
You'd switch it off right at the bottom, just before it turns around, and then you'd hate yourself for it.
Right.
A system is only as good as your ability to stick with it through the fire.
My personal role is anything over 25% drawdown in a backtest makes me seriously question it. If it's a longer-term stock portfolio, maybe you can stomach a bit more, but for leveraged Forex or crypto, a 25% drawdown can feel like 50% in real time.
It's the emotional leverage. That's a good one. All right, so we've survived the drawdown chat. What's next on the chopping block? I reckon it's win rate, the most overrated metric in the game.
Oh, it's a total trap. People are obsessed. My system has an 85% win rate, they'll boast.
Always.
And I'm like, cool, what's your risk to reward ratio on those trades? Yeah, silence.
It's the classic picking up pennies in front of a steamroller strategy. You make 10 quid, 10 quid, 10 quid, feel like a genius.
Right.
And then one trade goes wrong and you lose 500 quid. Your 90% win rate means nothing.
A high win rate feels good psychologically, I get it. It's a constant stream of little dopamine hits, but it can mask a catastrophic risk profile. Personally, I prefer a lower win rate, say 40 to 50%, as long as my winners are significantly bigger than my losers. Conclusively, a 3-to-1 reward to risk ratio with a 40% win rate is a money printing machine.
And it's more robust. Systems with lower win rates and high reward to risk are often trend-following systems.
Exactly.
They have a few big wins that pay for all the small losses. They are built to survive. High win rate systems, they're often mean reversion strategies that can get blown out by one single massive trend move.
Right. So to recap, we filtered by profit factor, checked if we can emotionally handle the max drawdown, and we haven't been seduced by a high win rate. Now we can get into the clever stuff, the fun ratios that make you sound smart at parties, if you go to the kind of buddies we do. Let's start with the OG, the Sharpe ratio, the one that all the hedge fund managers have tattooed on their forearms. In street terms, the Sharpe ratio measures your return for every unit of risk you take.
Okay.
The risk here is volatility, both up and down. A high Sharp suggests you're getting smooth, consistent returns. A low Sharp means it's a gut-wrenching, bumpy ride.
But the problem with Sharp, in my world, is that crypto is all about volatility. A massive green candle that doubles my money is technically risk in the Sharp model.
Right.
It's like, hey, calm down, mate. You're being too volatile. I don't want to be punished for that.
And that's why we have the Sharp ratio's smarter, streetwise cousin, the Sortino ratio.
Ah, okay.
The Sortino only measures downside volatility.
Okay.
It understands that upside pumps are the good stuff. It only penalizes the system for the scary, red, downward-facing risk.
So that's a metric that gets it. It speaks my language. It differentiates between good volatility and bad volatility. So if you're comparing two systems and one has a higher Sharp, but the other has a higher Sortino,
Yep.
what's that telling you?
It's telling you the system with the higher Sortino is probably giving you a more pleasant ride. It might have some explosive moves to the upside, which the Sharp penalizes, but it's better at protecting you from the nasty drops. For most retail traders, the Sortino ratio is a much more practical measure of quality of life. Love it. There's one more ratio I've seen in the CMT books that sounds proper gnarly. So, curious. The Sterling ratio? The Sterling. It's ruthless. It's like the distilled essence of our drawdown conversation. It's your average annual return divided by the average of your biggest drawdowns. It's not interested in volatility or standard deviation. It asks one cold, hard question. For the amount of pain this system inflicts on me, how much am I getting paid? Precisely. It's the is the juice worth the squeeze ratio. It's probably the most practical risk-adjusted return metric of the lot. Conclusively, if a system has a high Sterling ratio, it means it's delivering great returns without putting you through absolute emotional hell. It's a robust, efficient system. So you could have a system with a mediocre Sharp ratio, but a brilliant Sterling ratio, and that might be the better system to trade in the real world.
100%, because it's optimized for human emotion. Okay, but we need to talk about the massive, stinking elephant in the room. You can backtest a system and get perfect scores on all these metrics if you cheat.
Let's talk about the dark arts. Let's talk about curve fitting.
Or, as I call it, torturing the data until it confesses. Curve fitting or over-optimization is when you tweak and tune your system's parameters so much that it perfectly nails the historical data you tested it on.
Yeah.
You adjust your moving average from 49 days to 51 days because it gives you an extra 2% return.
Yep.
You add a filter that says, don't trade on the third Tuesday of the month if it's raining. And you end up with a backtest that looks like a masterpiece, a work of art. I call it the Instagram versus reality of trading. The backtest is the perfectly angled, filtered, photoshopped selfie. Blunt, live trading is seeing that person on a wet Monday morning with a hangover.
Right. It is the single biggest reason why systems that look amazing on paper blow up in the real world. The system hasn't learned an underlying market dynamic. It's just memorized the past. It's like creating a cheat sheet that only has the answers to last year's exam. You're going to get destroyed when the new test comes out.
This is where the broader concept of data snooping bias comes in. Even if you're not intentionally curve fitting, if you test 100 different ideas on the same data set, you haven't found a real edge. You've just gotten lucky in your spreadsheet.
So how do we defend against this? How do we call bullshit on a perfect backtest?